Hello, welcome to Beyond Blue Chips, where we dive into why you should consider investing in microcap and small cap companies as part of a diversified portfolio. My name's Harry, and I'm your guide to discovering hidden gems and the next big growth stocks that lie just beyond the blue chips. So get ready to uncover the exciting opportunities and diversification benefits that these stocks have to offer. So first, what are microcap and small cap stocks? Well, they are basically companies that have smaller market capitalizations. Microcaps usually have a market cap under $300 million, whilst small caps fall within the 300 million to 2 billion range. These smaller companies might not be on everyone's radar, but that's where the magic happens. You might be thinking, why bother with these smaller players when there are plenty of big name, larger cap stocks out there? Well, in this video, we will explore the higher growth opportunities, find undervalued gems, and tap into the diversification benefits of microcap and small cap investing. So let's get started. One reason is the higher growth opportunities. So if we start with exciting growth potential, unlike large companies that already dominate the market, microcap and small cap stocks have plenty of room to rapidly expand their revenue. These small firms are often in their early stages and have yet to fully penetrate the market or fully unleash their product or services' full potential. So this makes it easier for them to achieve exponential growth as they can multiply smaller revenue numbers more easily. For example, Tile by Design, a hypothetical small company I just made up, they can easily double their sales by, say, expanding to a new state and doubling its revenue. It can then double again and keep doubling whilst increasing its value. Whilst big expansion does come with challenges, it can be done with good management and a great product or service. But in contrast, larger companies like Apple, they face difficulties in doubling their already substantial revenue. So it would take a huge amount of time for a $1 trillion company to become a $2 trillion company. And so the inherent advantage of small cap and micro cap stocks lie in their ability to experience rapid growth and make them attractive investments for those seeking big returns. So Tesla, Amazon, and Netflix, they all started as small micro-cap businesses in their respective industries, but have since expanded exponentially and made potential life-changing returns for their early investors. Another reason is they're often undervalued gems. Market inefficiencies and a lack of coverage and analysis means they're often cheap. So let's talk about uncovering these hidden gems. Since many of these stocks fly under the radar of many big institutional investors and analysts, market inefficiencies come into play. There are fewer eyes focused on them, creating opportunities for diligent individual investors like yourself to discover undervalued stocks before the broader market catches on. This lack of coverage and competition allows you to find those diamonds in the rough that can offer a big margin of safety. There are three primary reasons that contribute to the lack of institutional coverage. So, firstly, analysts have a limited time and tend to prioritise large cap stocks that generate more interest. So, as a result, smaller companies receive less thorough analysis. Microcap companies may be exempt from certain reporting requirements, such as filing regular reports with the Securities and Exchange Commission, or the SEC, in the United States, and generally do not report to the same level as larger cap businesses. Thirdly, the illiquidity of these cheaper small cap stocks makes it challenging for most funds to invest any significant amount of capital in them. The stock prices of these companies are often more sensitive to demand, and larger funds may not find it worthwhile to allocate resources to such stocks. For instance, a large hedge fund managing billions of dollars would not typically invest in small or micro cap businesses, as it would have a negligible impact on their overall performance. So, even if they did decide to invest, the increased demand from their purchase would bid up the stock price, and so that reduces its attractiveness and potential upside. Warren Buffett said in 1999, "If I was running $1 million today, or 10 million for that matter, I'd be fully invested. It's a huge structural advantage not to have a lot of money. The universe that I can't play in has become more attractive than the universe I can play in. I have to look for elephants. It may be that the elephants are not as attractive as the mosquitoes, but that is the universe I must live in." So what Buffett was saying there is that he can't buy microcap and small cap stocks or mosquitoes because he has too much money. He would move the stock too much and not move the needle of Berkshire Hathaway. He has to look for elephants, which are the large and mega cap stocks, and not the smaller or micro cap stocks or mosquitoes. But having said that, in 1982, Warren Buffett bought See's Candy for $25 million. So in today's money, that is around $160 million. So that would classify it as a microcap business. It has since earned Buffett over $2 billion, and its reported annual revenue is now around $410 million annually. There's also a historic tendency to outperform blue chips. So here is an interesting fact. Microcap and small cap stocks have a historical tendency to outperform large cap stocks over the long term. Studies have shown that they've delivered impressive returns compared to their larger counterparts. So it's like having a secret advantage in your investing journey. A Schroders study found that $1,000 invested between March 2001 and February 2017, the global large caps value was worth $1,438, whilst the small caps was $2,903. A Motley Fool study found that an S&P 500 ETF between 2000 and 2019 had a 226% return, whilst the Russell 1000 ETF, which is the 1,000 smallest traded stocks on the market, had a 312% return. The Credit Suisse Investment Yearbook in 2018 noted that between 1900 and 2018, US small caps annually returned 12.2% compared to US large caps, which returned 9.9%. And finally, the author of the Confessions of Wall Street Insider for a CRSP study, University of Chicago Center for Research in Securities Prices, found that over a 79-year period, microcap and small cap stocks outperform large caps by 437% to 165%. There's also diversification benefits in investing in small cap and micro cap stocks. These stocks have a lower correlation with large cap stocks and mega cap stocks and even other asset classes. So by adding them to your portfolio, you can potentially reduce your overall portfolio risk and tap into different growth opportunities. So this means that their price movement may not align with broader market trends or other segments of the stock market, but by adding small and micro cap stocks to a portfolio, investors can potentially reduce their overall portfolio correlation and mitigate risks associated with larger market fluctuations. So it's like being part of an exclusive club that others may have overlooked. There are also different growth opportunities. So small cap and micro cap stocks and companies often operate in niche sectors or emerging industries. These companies may have different growth drivers and, say, business models compared to larger, more established companies. Or they may even have a new emerging disruptive technology, for example. Investing in these stocks provides exposure to unique growth opportunities that may not be available in larger companies. So this diversification can also help mitigate risks associated with relying solely on large cap stocks for growth. So as discussed earlier, there are market inefficiencies as these small micro cap stocks are typically less followed and researched by the big institutional investors and analysts compared to the larger and mega cap companies. This relative lack of coverage can lead to market inefficiencies and mispricings, which can create potential opportunities for skilled investors to find undervalued stocks. There's also potential for outperformance. Again, as I said earlier, historical data suggests that small cap and micro cap stocks have the potential to outperform large and mega cap stocks over the long term. Whilst this is not guaranteed, the smaller size and higher growth potential of these companies can contribute to stronger returns. And adding these stocks to a portfolio can enhance overall performance and potentially increase the chances of achieving higher investment returns. There's also investor empowerment to take into consideration. So it's not just about the financial gains. Investing in these smaller companies can actually empower you as an investor because you have the chance and opportunity to support innovative businesses and make an impact with your investment decisions. Witnessing a company that you believed in and continue to believe in alongside your own money can be very rewarding. But of course, it is important to remember that investing in micro and small cap stocks, they do come with risks. They can be more volatile, they have lower liquidity, and they do carry greater uncertainty. But fear not, Beyond Blue Chips is here to guide you through strategies to help mitigate these risks and ensure you approach micro cap and small cap investing with insight and discipline. So thanks for watching, and until next time, happy investing.